Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with my partner, Jim Riggio. Before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. And with the disclaimer out of the way, Jim, welcome back. It's been a while since you've been a presenter on the roundtable.
Thank you, Tom. One of the things that was happening is that Tom and I had gotten a couple of questions, and we ended up speaking the other day. We ended up taking a look at two identical trades at expiration. One ended up using in-the-money puts, the other one used out-of-the-money calls. And on I think we were using a 8 lot or a 4 lot, I forget. But the delta difference was 10. Okay, now a 10 delta on SPX is absolutely huge. And there's a lot of back and forth. We've also ended up hearing people end up saying that with some of the different strategies, if puts go into the money, sometimes it's a little bit more difficult to end up actually getting things executed. So what we wanted to end up doing is that we wanted to I was going to end up showing you a couple of examples, and then we'll end up taking questions and we'll going through different examples. But Tom, I'd like to end up starting with the trade that we looked at yesterday. When I looked at it about 15 minutes before the call, the delta difference was only about 3, okay, which actually concerned me even more because if the deltas aren't something you can end up relying on, how do you trade? The deltas also end up affecting the way your T-post-zero line looks. So if you're a visual trader and you trade off of the analysis graphs, that also becomes a really big problem. Tom, I do have the ball, right? I just have to end up accepting.
You do. Yeah, you just have to hit the share.
So let me share this screen. And tell me when you can end up. You should be able to see it now, right?
Yep, looks good.
Okay. So what Tom and I were looking at yesterday, we were looking at a risk profile that looked somewhat like this. Granted, the market has sold off quite a bit, so we were over on the right-hand side of the chart somewhat. But when we were here, I asked Tom, I said, Tom, do you notice anything different? Now, I've been looking at these things a long, long time. Normally what ends up happening is that when you end up having a butterfly, or a narrower condor like this. Now, granted, this one you can see that the left wing or the lower wing is a little bit longer than the right wing. And you can see that without even knowing where the strikes are or doing any of the math, because you can see that the left wing goes lower in terms of its maximum loss. But even with that extra 5 points or so that I have on the downside, we still expect, because of the put skew, remember what put skew is. Put skew is that the implied volatility of the puts below the money is going to be higher than that at the puts towards the money. And what I'm going to end up showing you, I'm going to show you 2 things during this. I'm going to end up looking through Thinkorswim, and then I'm also going to end up going through Live Vol to be able to end up showing that to you. Tom, I'm going to try to keep a chat on the side, but if questions come up, please let me know, because I do want this to be interactive, guys. Ask me whatever you can answer. I assume that everybody can see my screen, right? Because I see one message, maybe. Okay. One of the things that you can end up doing, okay, to be able to take a look at it, and this is my way of cheating, okay. You can go in, you can do all of the analysis. What I end up doing to end up saying, well, I want to see the way the Greeks the way they should be, I end up putting a box on. Does anybody know what a box is? It's an old floor trader term. It's a trade. You used to trade against the box. Okay, I got a couple of yeses. What a box is, it's a zero risk trade where I will be selling a call spread and then also selling the opposite put spread. Okay, so if you take a look at it, let me end up showing you what we're doing here. Okay, this is a box where if you take a look, I'm selling the 2100, 2125 call spread, right? So I'm short the call spread. Then I'm actually long the put spread, but the way I have to put it in the iron condor is I actually flip it around where I'm selling the 2125 and then buying the 2100. So what ends up happening is I have two verticals that cancel one another out. Okay, that's what a box is. Okay, and John Dory got the exact thing right. It's long and short the same spread. The reason why I put in the iron condor, it's easier to end up putting it all in one. John, your way may be easier, I guess, for somebody as a beginner to seeing. You're long and short the same spread. You use puts and calls to end up basically switching this. So if you take a look at what I'm doing here, that instead of having a chart that would end up being, a graph that would look like it would be higher on the left, it would be a 45-degree angle down to the right, and then flat on the right-hand side, where that would end up being, it would look like a short call spread or a long put spread. I have them both rolled into one trade. Now, they're both 25 points wide, so this should always trade at 25 or thereabouts. Now, you'll never be able to end up getting it, okay, executed at 25, because why in the world would anybody want to trade with you, go through the effort of trading with you, pay the exchange fees and commissions just to make nothing? So you'll never get a credit of $25 or more for this, but you might get a credit of $24.90, $24.95. It ends up moving. What I'm going to do for the sake of this, I'm just going to end up locking it down at $25. So you can end up seeing that once my slow think or swim system finishes here, it's exactly at zero. Okay, the T plus zero line is going to end up being over because of, by the way, T plus zero line really should also be at zero, right? There's no reason why it should end up being this far out of whack. So when I take a look at the put condor that I ended up having, and I just want to do one lot here so you can end up seeing, and I actually put this on in live vol so you could end up seeing the difference. Here's where my deltas look like. They look like they're they're +6, okay, and you can see my gamma, you can see my T plus zero line. Look what happens when I take this long put spread over here on the right and I flip it, right? Instead of it being a long put spread, I'm going to turn it into a short call spread, and I'm going to do that with the iron condor, okay? I went from 6 down to 3 in my deltas. When I clicked it again, I want you to look at the T plus zero line over here. The T plus zero line moves up pretty significantly. See, off, on, off, especially over here. You can see what ends up happening with the T plus zero line. That should not happen. Okay, if puts or calls get more than, a nickel or a dime, out of whack, the markets will bring them back into line. Okay, there's plenty of computers out there that do arbitrage that make sure that we have put-call parity, and their tolerance are set pretty low that it won't end up varying very much. This is an issue, okay? What's even a bigger issue was the other day when Tom and I were looking at this, okay? It was not 3, okay, delta difference. It was a 10 delta difference. That's an enormous difference on this size of a trade. It's very, very difficult to be able to end up seeing this. So, one of the things that I've used as an example, or I've tried to draw an analogy for you guys. When I was in college, I laid my motorcycle down on its side. I bent my handlebars, and I learned to ride with my bent handlebars. Years later, when I got my next bike, okay, and I had straight handlebars, I didn't know how to ride it because I kept turning to the right because I was used to bent handlebars. I'm used to bent T plus zero lines on Thinkorswim. But when you're learning, it's really hard to learn how to ride a bike with bent handlebars. It's really hard to end up learning to trade this properly with an incorrect T plus zero line and incorrect Greeks. Now, this is the challenge, and I know there have been lots of discussions, okay, between OptionView and OptionNet Explorer or Thinkorswim and other people's Greeks. But what I wanted to be able to end up showing you is how and why some of these things end up happening, especially in the indexes, okay? When you think about, well, what's going to end up causing the difference? Some of the differences are they calculating the dividend correctly? Okay, and then are all of the other formulas right? But it's usually how they're going to end up handling the risk-free rate, which these days there's no difference, right? Risk-free rate means zero. And how they end up handling the dividend. The dividend is especially difficult to end up calculating because of in the indexes, the cash settled indexes that we all love to trade, right? We love to trade the SPX, the RUTs, and the reason why we love to trade those are the great 60-40 tax split, right? The 1256 contracts that mean that 40%, only 40% of the trade, even if we day traded these options, would be considered short-term capital gains, 60% are long-term capital gains. So they're very, very popular, plus their size, right? They're 10 times larger, and while some people, okay, depending on your accounts, almost every brokerage except for Thinkorswim, you're going to end up paying exchange fees on top of that of, 30, 40, 50 cents. It's still worth it for the size and the tax treatment. Let me take you over to some of these options on LiveVol because they do a much better job of actually explaining it. What I end up having here, okay, this is their option montage for those of you who aren't used to it. I just set up, okay, standard Greeks, open interest volume, my Greeks, implied volatility. By the way, you can set your own volatility models if you wanted to. You can end up importing them. Unless you're a quant, I would not suggest you do that. But what I want to end up doing is I want to end up going up to the maze, and let's just choose one of the options that we ended up having here. Okay. If I end up coming over here, what I end up having is that I have my bid, my ask, and my theoretical price. It's not the mid. It's their theoretical. When I hold my cursor over the theoretical, I wanted to go through some of these things because it actually ends up explaining, okay, how they're calculating, okay, the options price and also the Greeks, because that is what goes into the model when you're looking at your T+0 line. That is the model that goes into when you're looking at your Analyze page or Thinkorswim or other places. And they kind of end up going through everything. So let me just go through real quick. You end up having your time. That's the T. They measure T the way it actually needs to end up be putting into the formula in years. So 0.044204 is how many years, okay, less than 4% of a year, are left between now and expiration. We end up having risk-free rate is R, which is always going to end up being 0. B is really not that important if there's anything that needs to be calculated into it for the individual stock, okay, if it's hard to borrow. Sigma is going to end up being basically we always think of it as standard deviations. Now S. S is where the rubber meets the road, okay, if you take a look at it right below Sigma. That is the forward price, okay, and here's what the forward price is. You don't collect a dividend on a cash settled index, otherwise it wouldn't be cash settled. The dividend is calculated into the price. How do you end up knowing where those prices should end up being? Some of the folks, okay, some of the different options models, I know OptionView does this, they actually take the dividend and they calculate it and they put it into the price. They take a look at the risk-free rate and they take that out. So what they're basically doing is saying on expiration, okay, of this contract, given everything that's going to end up happening, what is the current price, but what is the current price in terms of future, meaning on expiration? That's the proper way to calculate what your Greek should end up being. So this whole thing about what do my Greeks actually end up looking like? Is my T plus 0 line right? How do I end up measuring that? Is somewhat of an issue for a lot of folks. You know, I'm just going to show this real quick because I know that there aren't a lot of live folks out there, but I'm going to end up showing you they end up having a risk chart that looks something like this, where I can take a look at it over the next 8 days. I can take a look at 10, 25, or 50%. I can take a look at a 1 standard deviation move over the next 8 days, a 2 standard deviation move, or 3 standard deviation move. And I can see what my T plus 0 line looks like, and then here's all of the dates. So it's similar. I like this because, you know, while I want to end up seeing my expiration graph, I really need to be trading what it's going to end up looking like. And while this is a pretty picture, it's not the one that I tend to end up using. The one that I tend to end up using is that they have a position analyzer, which also ends up going into the portfolio analysis. And here, I can end up taking a look. I'm looking at my positions. If I wanted to model things, I could end up modeling a whole bunch of changes. But what I end up tending to do here is I'll look at 10%. Okay, and here's what my T plus 0 looks like. They also have 2 different models, and this is why I like this. One model is what everybody else, okay, that I know does, and it's a static model. It just keeps the implied volatility flat. The other one, the dynamic one, and we've all seen this happen. This is what happens, you know, at least 80 or 90% in reality. When the market drops, the implied volatility goes up, but the implied volatility goes up more at the money than it does, let's say, 5 or 10% below the money. And when that happens, okay, which usually happens most of the time, we call that the put skew is flattening, because what that ends up doing is that it says that the implied volatility is not as high when I look below the money. Let me show you on Thinkorswim, because I know that most of you end up using Thinkorswim, what I end up meaning on that. If I come over and I take a look at my chart, just my options chain. If I take a look at a put at the money, my implied volatility at the money is 15.7, 15.71 or so, right? Everybody, you can see that? Now, if I end up going down, and let's say I go down not even 10%, but let's say if I go down, 5%, okay, 5% would end up being around 1945. My implied volatility goes up to 20.06. As you can see, it's more than 25% higher in terms of its relative value, in terms of the implied volatility. Remember, a lot of people say, well, why should I care about this? Well, if you're trading more than one leg, guess what you're doing? You're trading one implied volatility versus another. If you're trading a butterfly, you're trading, one volatility, your short strikes, against your 2 long strikes. If you're trading an iron condor or a regular condor, you're trading your short implied volatilities against your long implied volatilities. When you take a look at any trade, I've been asked about, my Kevlar. And the same is true, by the way. I know a lot of you guys follow Dan Harvey. Dan and I talked about this, for, the last 10 years. And if you follow Dan and Tom's trade, what we all end up trying to do is that we're trying to end up selling the highest implied volatility for the most amount of money. Okay, very important. The highest implied volatility for the most amount of money. What does that end up meaning? Well, it's easy to see the implied volatility on here, right? Because the further I go down, the higher the implied volatility goes. I only have 50 strikes here, but let me make it 100, not 10, and you can see that the implied volatility now is at 32, okay, versus when it was only, a little over 20, okay, at the bottom. So it just keeps going up. Now, the problem is that this is great. You're saying, hey, I'm going to sell really, really, really high implied volatility. So I'm going to sell the 1775s. Well, the problem is that I'm only going to get about 30 cents for it. So the further I go out of the money, on the put side, the higher the implied volatility gets, but the lower my actual value or my extrinsic value, okay, the time value of money, okay, ends up getting here. Whereas if I sell the strike directly below the money, okay, it's still 100%, okay, if you take a look at this, let's shoot this one. Okay, it's still going to be 100% of extrinsic value here, but I'm going to end up getting in the neighborhood of $25. But the problem is that even though I'm going to get the most money in terms of my extrinsic value, I'm selling only at 15. So here's where we get edge in trades. Okay, we get edge when we sell at the crossroads of the highest implied volatility and the highest extrinsic value. Okay, where is that exactly? You know, it'll vary with time. It'll vary with how high implied volatility is, and it'll vary with put skew. But in general, right, in general, it's going to end up being somewhere, you know, below the money, not directly below, but, you know, 3, 4, 5, 6%, depending on how far you go out. So if you end up going and taking a look at any of the successful butterfly strategies that I know a lot of you guys follow, right? Some of you guys follow, okay, the road trip. Other guys follow the Rhino. Other folks might follow John Locke's M3 or other trades. What are they doing? They're all butterflies below the money, and they all end up having this type of edge where they're trying to sell the highest implied volatility for the most amounts of money. Now, once you choose what you're going to sell, then the question is, well, now how do I end up managing risk, right? Because in a perfect world, you'd sell the volatility, you wouldn't buy anything, and the market would never go below it. But the problem is when it does go down, you could get killed if you do that. So everything else that we end up doing is trying to end up managing risk around it. What I'll end up doing is that I will end up showing you guys a current trade that I end up having on for my Kevlar guys. Okay. What you'll see is the check boxes are what I've actually have on. It was just a simple butterfly, okay, a symmetrical butterfly, okay, below the money, and I bought a long call to be able to hedge it. Some of you guys might look at this and saying, oh, that looks a lot like, you know, the way John Locke does his M3. And the answer is, yeah, it's not remarkably different. The way we manage it's different. The way we select our strikes different. When we enter it's different. I mean, we each have our own little nuances. But, you know, the general principles of selling the high implied volatility is exactly what we tried to end up doing. Now, what happened yesterday is that the market dropped down, implied volatility went up, and the implied volatility of the puts closer to the money, okay, went up more than the implied volatility of those well below the money. So what I did yesterday, okay, was that yesterday I ended up putting on a broken wing butterfly for my July trade. And here, what you can see, the reason why this makes sense is that what we're doing is we're taking advantage of the way the options were. So I'm selling things here, and the difference between this short strike and when we're out here, when implied volatility ends up going up and it drops significantly, I'm sorry, when the implied market drops significantly, implied volatility goes up and the put skew flatten, we can end up taking advantage. You know, the reason why I wanted to end up going through this, if I just go back to, you know, the standard simple little trade that we ended up starting to take a look at, how does all of this affect you? Okay, if you're in Thinkorswim, okay, or if you're in any other platform that does modeling, you should be able to end up putting a box, okay, to take your deep in the money options and flip them to a out of the money option. And you should be able to do this with anything, right? I'm doing it with a vertical spread. Okay, and that's usually what we're going to do most of the time, right? where you're going to end up saying, hey, how do I end up taking, okay, the long call spread and the short put spread, or vice versa, and flip them around? You flip them around with a box trade, an iron condor. Okay, make them both the same strikes, the same distance, and then you put in the price of what the distance is, and then it's a zero, right? If you're not sure if you've got it right, the way you end up doing it is you just calculate it, okay, the way it is, you put it in, and once the swimmer redraws it, you just make sure that your expiration graph is at zero. If your expiration graph is at zero, you've drawn it right. I'd like to end up opening it up to questions. Now, I wanted you to be able to understand, you know, why this was important. I wanted you to understand on any trade, you should be able to define your edge. Okay, I just explained to you how, you know, the Rhino trade, how the road trip trade, how, you know, nearly all of John Locke's trades, how my Kevlar works. Right? What do? We all trying to sell higher implied volatility for more money and then hedge it. Okay, that's where our edge is. Okay, we're all taking advantage of the same edge in different ways. If you can't define your edge, if you don't know where your edge is, you shouldn't be trading. You know, there was an old joke about sitting around a poker table. You know, if you go down to sit at a poker table and you look around and you can't find who the sucker is, it's you. Okay, if you can't define your edge, the market, you know, the market will end up taking advantage of you. Okay, a question here was the 2030 strike should be a 2025 strike on the green colored condor. Yes, it should be if it was an even, okay, condor. And I'll switch them both for you so you can see it. Okay, I'll take the 30. That's not what was I traded, right? That's not the way I end up having it. What I tend to end up doing is I'll always end up doing. So if I end up moving this and, okay, it's just on the downside. And let me just redraw this so you can see it. Okay, and so if you see here, so now we go from 4 delta, right? You see the 4 delta right here? Okay, to 1 delta. So we still have about a 3 delta difference. It really wasn't going to make much of a difference, okay, in what I had done in that example, because what we were changing was the out of the money puts, right? Where I moved this up 5 points. I'm sorry, it's 30. I moved this up 5 points. So it's still out of the money, so it's not going to have a major difference. The change is going to happen when you end up changing the in the money, okay, options. That's going to end up having the biggest difference. When would you put on the M3 style with a long call versus the broken wing style? We use an institutional level tool that shows us, okay, what the put skew looks like. You as a retail trader have one of 2 choices. You can either take a look at and keep track of and calculate on pretty much on a dynamic basis where the implied volatility is at the money versus where it is, you know, at some fixed point below the money. I will tell you that when you do this, traders will end up having an argument. Should I always look at the 50 delta versus the 10 delta? Or should I look at the money and the, let's call it the 8% below the money option, right? Do I do it with fixed deltas or do I do it with fixed distance? The studies that I've seen from Goldman Sachs and other places indicate that doing fixed distance tends to end up being more accurate than fixed delta, because deltas will actually move with implied volatility. Deltas will move with the difference of the skew. There is, and I forget, I know somebody else will know how to end up doing this, but there is a way to end up looking at skew. I think it's product depth here. Yeah, it is. Okay. Here are the implied volatilities of the calls and the puts. Okay, and each one of these is listed down here of where it is. To me, this isn't really helpful. I mean, it's mashed together. Plus, the Thinkorswim stuff means that I have to look at the puts on the left-hand side, right? Because we've already said that they're out of the money. Things are incorrect. And you can see that here very, very distinctly, right? If you take a look at how the implied volatility of the puts goes above here versus take a look at the implied volatility of the calls, okay, below the money. They're not calculating the dividend and other things correctly, okay, and the graph shows it to you. What I tend to end up looking at a lot more is that there is a skew chart that's a lot easier to end up seeing, okay, on LiveVol. What I tend to end up looking at is I'll take a look at the first 6 months, I'll take a look at the 10% out of the money, and now I'll take a look at just those things that are trading over 25 cents. Then I can end up clicking on anything that I may or may not want to end up seeing. So, if I just unclick, let's say, the first things, I can just go through this pretty quickly and saying, okay, here are the ones that I want to end up seeing. Okay, and now I can take a look at it. Now, what I tend to end up doing is that I'll end up having this chart open a lot. Okay, and then I'll end up keeping an eye on, my specific options and where they are. And then basically the chart, it's a little bit easier way to be able to see. It's not a quantitative tool. The only way you can do a true quantitative tool is to actually, and I know that some of you guys have built this, where you actually build interfaces that end up going and taking the implied volatility down of each of the strikes and then do the math like in an Excel spreadsheet to be able to give it to you. The challenge that we all have, by the way, when we do that is that that's very good when we're looking at an individual, okay, options chain. But what it doesn't give you, it doesn't give you any prospectus to history. Okay, you have to do one of two things. Okay, either you have to end up keeping track of it in your head, or you need to have a tool that ends up giving you some history of it. What we end up having is that what we end up doing is that our tool gives us a constant 30, 60, 90 days, by the way, which is what LiveVol does in terms of its entire implied volatility. So I just want to show you this. When I take a look at their charts, I can take a look at any of the implied volatility or any of the historical volatility. One of the big challenges I see a lot of people end up making mistakes on is that they will end up saying, oh, the 30-day implied volatility is high, so therefore everything is high. Well, no, that's not necessarily true, especially when you take a look at any type of event. There might be a Fed meeting that's coming up, or a major international election, or an earnings for an individual stock, where the 30-day, the 60-day, they're going to end up changing pretty dramatically, when you end up having this quote-unquote event risk. So it is a little bit more of a challenge. But if you know where the events are, you've been tracking it, you can end up tracking it. It's not truly a quantitative tool, but you do get a feel, from trading after a while. Let me see. In Thinkorswim, can you turn off some of those lines, for the skew? The answer is I'm not really sure how to do that. Let me just go back and get my Thinkorswim. Let me pull it back up here.
Mark Mosley says, yes, you can.
There I go. I can select them here also, underneath series. Okay, and the other thing I can end up doing here is I can choose number of strikes that I want to see. And I can end up doing it in out of the money. Okay, this is a good example. Okay, so they're still doing this. Take a look at, and let me, instead of doing all strikes, let's get this thing to be so it's more reasonable. Take a look at the big drop, how the implied volatility looks at the puts versus the calls. That big drop, okay, tells me that they don't have put-call parity built into this thing. So I'm still not trusting it. I've traded it long enough to know that the Thinkorswim, okay, Greeks, because they don't do a great job with the cash-settled, no dividend payment indexes, the SPX, the RUT. So I know when people end up talking about OptionView versus OptionNet Explorer or other tools, if the tool is only pulling their implied volatilities and their Greeks from another system, I don't know if OptionNet Explorer still does this. I know they used to pull their Greeks down from Thinkorswim. Their tool will only be as good as the Greeks, okay, that it's pulling down. That's why, OptionView, if you ever heard Lynn or any of their technology folks speak, they have spent, years and years building out their volatility models. Okay. So I showed you how to use some things. Any other questions in general? The other thing that you can talk to some folks about, how do they end up dealing with all of this? For those who were on my Kevlar, a few months back when we had a pretty big drop, I ended up trading. I put on a trade, and I did it one of those 75-point upper wing, 100-point lower wing butterflies. I did the whole structure so that it was just slightly below the money, and I ended up paying less than $4. I know that was like an all-time record for me. I know that was one of the cheapest prices, okay, that I had gotten, which meant, without me even looking, implied volatility was extremely high, and the put skew got much flatter. It really comes down to, do I know my prices? I don't know how many of you guys know Paul Demers, but Paul and I used to end up being trading buddies. We worked together on a lot of different trades, and I remember when I first started talking to him, because I was the trade advisor for one of his trading groups that he belonged to. And I started asking him, well, how much did you pay for this? And his answers were, I got a great price. I only paid, whatever it was. I paid $1 for buying this vertical. How do you know? Because I've been tracking it on OptionView. I've back-tested 6 years, and I've been looking at it for the last 3 months. And this is about as low as the price that I'm going to end up seeing, okay, for a put spread that starts, so many points below the money and so many points above the money. So it's a good trader is almost like a good shopper. You have to know your prices. If you don't know your prices, right, there's one of two ways to do it. You can either know your prices really, really well, or you can end up knowing the history of the implied volatility curves. You could do it either way. John Locke and I have had many a conversation about this. John is a guy who would just prefer it. He knows his prices, dead on. You tell him, 51 days, butterfly, this big, below the money, looks like this, at this price. So that's high or low. Why? Because he's just done it so long. You take a look at like some of the ex-Goldman guys, okay, that I had dealt with. You ask them that same question, they wouldn't have a clue. John would beat them, hands down. But they pull out their skew chart and say, oh my God, we're in 3 standard deviations. They both get to the same answer. They just get to it a very different way. The reason why, okay, the Goldman guys or any of the quant guys end up having advantages because they do have their quantitative tools, they do have their history, they do end up looking at this all the time, and they have to end up looking at different trades for different situations because they have clients that want to do different things. We don't have that burden that they have. They have to use a quantitative tool. We end up getting to end up trading the same trade all the time. The one thing that, I agree, and I've heard, several other, websites or instructors talk about, you can't do the same trade all the time. Dan Harvey will tell you, yes, you can. It just means that I'm going to, in certain environments, I'm just going to lower my profit expectations, which is another way of dealing with it. The way I dealt with it is that I have a bimodal entry, okay, where if the implied volatility gets higher, and put skew gets flatter, I'll use one entry. If IV is lower and put skew is a little bit steeper, I'll use a different entry. Your adjustments have to end up being different. You know, if the market drops and IV hasn't moved at all, buying a put spread, okay, could end up being, you know, very good. But if the IV's already, you know, spiked up high, you're going to want to end up using different adjustments. Again, you know, if you've traded as long as some of the folks that I've mentioned before, you kind of know that. And the reason why you know that is you've tried so many of them, you've back tested, and you've also traded it in real life, and you've lost money, okay, when you've used the wrong strategy. It's amazing, okay? I don't know if you ever heard the old expression, okay, especially in the options world, there are two types of traders, you know, those that have lost a lot of money at one point in their life and those that are going to. You know, you end up learning how to end up managing your risk, which is really, really important. Oh, God, I'm way behind here. If there are other questions here, I'm not sure if I completely follow or understood the discussion about the box credit spread. Okay, is there any, yeah, for those of you who didn't understand that, let me take you through it. I have a few more minutes, and I can do that. Let's go through here, and let's choose our options, and here's what we're going to be doing. Let me come over to here. Let me get rid of this. Let's go back to our maze. It doesn't matter which ones we ended up using, but I'll use the same ones here. Let me use the 21. Okay, so these are the in the money. So I'm going to come over here and let me do a sell, deep and wide, 4 strikes, vertical. Okay, and so let me move this to, oh, I did it the wrong way. I want to use the same strikes. So let me come over here and make this 2100. Let me come over here and make this, oh no, it was, I had it right, 2125. Okay. So what we're going to be doing is that if you take a look at this, we're taking a credit in for selling the put spread. Now let's go in and let's buy the call spread. And let me make this one a bit wider. Okay, and so let me make this 2125. Okay, now when I take a look at these two, and I take a look at the risk profile, 2125, I did this one backwards. Okay. If you take a look at what's done here, okay, I have the exact same trade on, but with puts and calls. If you take a look, I am selling the 2125 call. I'm sorry, put, and I'm buying the 2100 put. I'm doing the exact same thing. I am selling the 2100 call, and I'm buying the 2125 put. So when I add these two things together, it comes out to be $25. I have two short spreads for $25. So therefore, the credit that I receive is the same that these things are trading as a debit. Okay, so therefore, when these things are together, okay, they should be trading at $25. By the way, years ago, the way options traders used to end up doing the put-call parity, they would just trade the box against you, because if I could trade this and I could make a dime, I locked it in, I'm not going to lose the money. So they would trade boxes all the time, but what ended up happening is that computers got a lot faster than floor traders. So it's done, okay, by algorithm now. Okay, so it's just easier, right? It's just easier. Instead of putting this in two separate trades, I put them in one iron condor, I put the same thing down, I lock it to 25. And then I can just click once and on and off. That's the way to be able to end up using a box to be able to take your in-the-money put spreads or your in-the-money call spreads, doesn't make a difference, right? But to take your in-the-money spreads and make them out-of-the-money spreads and to be able to see if that changes your T+0 line or your delta. Now, this is definitely true for thinkorswim. There's no need to do this on LiveVol. And on IB, Tom, I'm not sure. I don't trade IB natively. I trade IB using the LiveVol front end. I don't know if you've looked at this enough, okay, or know historically enough about the way IB does it.
Well, IB doesn't have any graphical tools like this that I use, so I just do it all in Option View.
Okay, and then Option View also, you don't have to do this in Option View either because they've spent a lot of time also to be able to take a look at it.
Hey, Jim, we did have a question about LiveVol, or I guess Lightspeed, discounts for Capital Discussions members. Do you have anything we can update everyone on?
I do. Tom and I are finalizing everything, but what we're going to be posting, hopefully within the next 2 weeks for you guys, is that if you sign up with the Brokerage Lightspeed, okay, you will end up getting, and I'm going to compare this directly to IB, okay, or to the Lightspeed rates, okay. You will end up getting a nickel discount per option off of the list price. If you are a member, okay, that subscribes to any one of our services, you will get a 10-cent discount. Okay, we're working to put that up. Okay, like I said, we need to end up finalizing everything and get the deal in place. But you know, you can definitely expect it before the end of the month. The other thing is that if you try, okay, the LiveVol platform, and you say, you know, nah, I'd rather just go to the plain IB platform and use the Trader Workstation, which is the native IB interactive broker platform, you can end up using that. So there would really be no reason to ever sign up directly with IB because, you know, if you're, like I said, if you're a gold member, okay, you're going to get a dime discount per contract, which can end up really adding up for you over the period of time. It is significant. It is significant. Okay, Tom, do you have their list prices? I believe that they would their list prices were
for
65 cents or for either.
Yeah, I think it's 70 cents a contract plus exchange fees.
Yeah, that's what I thought. That's what I thought. I thought that's the base, and so you'll get them for 60 cents or 65 cents if you're not a subscriber to any service. And so I mean that's significant. If you guys take a look, go back and take a look at what your total commission bill was last year, and think about if you could end up saving 10 cents per contract on 70 cents. That's about 15% of that money back. That's pretty significant.
And Edward, that 70 cents is per contract for IB's standard rate. Minimum
is the
$1
standard?
Minimum $1 per trade. So if you do a one lot, it's $1. But
yeah, there are some minimums, by the way. Also, the minimums are slightly different. I think that the minimum, okay, is it might be $3 for Lightspeed. We'll have to take a look at that, and you can take a look at the details. But because of the way we trade, most of us anyway, most of us end up trading in structures, butterflies, condors, verticals. So having, you know, a 3-contract minimum or a 2-contract minimum isn't a big deal, I don't think, for any of us. At least I hope it is. Okay. Can you trade multiple accounts? Yes, you can. Okay. IB has a multi-account, okay, system that actually is extremely good. Extremely good. In LiveVol, you can also switch multiple accounts. The challenge with using LiveVol directly, you can't end up selecting like you can in IB. In IB, you can end up grouping accounts. Like I want to see all of my IRA accounts together. I want to end up seeing like all of my family member accounts the 3 family member accounts that I end up trading. You can't group them. You have to kind of loop through them one by one. For somebody who's doing multiple accounts for friends and family and things, you're probably better off using IB directly for that. Okay,
yeah, that's
but if
their advisor account.
Yeah, they end up having their advisor account. just a word, because I've gotten asked by this, because I know that what some people end up doing is that they end up trading, their account and their IRA, and then they have their wives or their husbands, and then the daughter. You do family members, no problem. I do know a couple of you guys who've asked me, hey, I have friends who end up saying, oh, can I trade from? The answer is just be very careful, okay? If the SEC, okay, finds out that you're doing that, or if your state regulators find out that you're doing and it could happen from anything, right? Sometimes they just do sweeps of these smaller accounts because they know a lot of people do this, and you don't have all your paperwork or you're trading other people's money. They'll shut you down immediately, and you'll never be able to end up, getting your license or being able to do that legitimately later on. So just be real careful, okay, and make sure that you follow the rules. The nice thing about I do like about IB is that their compliance is very stringent. Okay, they're very, very strict about having the right paperwork, having all the sign-offs. So if they say that you're good, you're probably good. Okay.
All right, I think that's it for the questions, Jim.
Well, hopefully this was helpful to a lot of folks. Shoot us any questions that we didn't end up answering. Be more than happy to end up trying to get you. And thank you, everyone, for participating in Capital Discussions. Tom and I greatly appreciate it.
Absolutely. So thanks again, Jim, for taking the time, and everyone for sticking with us all the way through. So have a great day, great rest of the week, and we will catch you next time.
Take care, everyone.
Bye.